So if you think about it, what is macroeconomic investing? It's using the economy to understand the direction, the future direction of assets. Why does that happen? Well, simply, if the economy is booming, people have more money to spend, and it tends to be positive for assets. And if the economy is slowing down or negative, then you tend to find that asset prices don't do as well. Kind of makes sense. Some assets work the opposite way around generally. So usually when things are slow, bonds do very well, but equities do badly, for example. And the easy way to see this, well, it's not so easy because you can't do it without putting it in a spreadsheet. It's actually the year-on-year rate of change of almost every asset, whether it's copper, oil, the S&P 500, bonds, yields, anything. They're basically related to I use the Institute of Supply Managers survey, the ISM survey, which is a monthly survey that basically tracks GDP, so economic growth. And it shows you that as soon as you make these things year on year, they look identical to the economic cycle. And that's the kind of big unlock, is realizing the economic cycle drives all asset prices. If you know where that's going, you can kind of make forecasts about asset prices. Yeah, once you've figured out the ISM and how it works, you can then find things that lead it. So that gives you an ability to forecast, okay, what it looks like. So currently I'm using a mix of the rise in interest rates, the rise in commodities, and the rise in the dollar. And it's like financial conditions. And that's suggesting that the economic cycle goes almost immediately to recession and pretty sharp. And I think a lot of people are sensing that is happening. You're hearing it from companies, you're hearing it from a lot of people to say, yeah, looks like we're going to recession. So the forward-looking stuff suggests we're about to go into a severe recession. So now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. And so where are we? So if I look at the year-on-year rate of change that I talked about, if I look at the S&P 500, it's already pricing in about 42 in the ISM. So a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. So generally, he who has cash in a recession is king, because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money. You want to be able to buy. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks? Because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore. So it's just their pension. So they need to be careful, very careful with their pension. Their nest egg has to be protected at all costs. Yeah. So it depends on how much risk you want to take and what time horizon you're investing in. If you're young, the single best risk reward is crypto, because it's the only market that goes up 10, 20, 50x, while the stock market may double, may go up 200% over the next 5 years. But crypto market does a lot more. So if your aim is to take risks to accumulate wealth, then crypto. I prefer crypto as a bet because I think it has a better risk reward than other markets. But you have to suffer these drawdowns, and a lot of crypto is down 60, 65%. But if you're less risk seeking, you might just want to buy equities. if you're slightly more risk seeking in equities, you might want to buy technology stocks, because technology is not going away. I mean, the rise of everything from AI to robotics to EV to space travel to everything is all happening at the same time. We've got this huge inflection point. So clearly that's going to be something that's probably going to generate a lot of profits over time. So I think it depends where you want to be on the risk curve. Some people like physical things, so they like to own stuff like oil companies, because there's not enough oil being produced currently for world demand. So maybe over the next 2 or 3 years that does well, but those stocks tend to be mean reverting. They kind of just go in cycles. They're not the buy and hold that technology can be or crypto can be. So I prefer technology and crypto overall. Back then, this was pre-Real Vision. So this was when I was writing, and I still write to this day, Global Macro Investor, my institutional research. I think people either ignored it or thought this is interesting, and people got involved. Because, you know, our job is to look for really interesting opportunities that other people haven't seen. So a lot of people weren't so skeptical. The skepticism came later in about 2017 when retail investors got involved. And then a lot of people didn't like it because the returns have been so big. They're like, at all times, it's a bubble, because they didn't understand how this kind of very powerful technology worked. So those voices of dissent were much bigger in 2017 all the way through to today, because it's questioning people's very system of understanding of financial markets and what is technology and how do they work. They kind of think it's crazy that a bunch of us are happy to see the market go down 70% and think that's normal, and then go up 20x. They don't see those kind of things, so they don't understand it, so they're kind of fearful of it. But in the early days, people were much more like, this is interesting. Much like we're observing the rise of AI or what Elon Musk is doing in space. They're like, it's interesting. But when it becomes a big thing, they all go, no, this is crazy. Okay, I'm going to give you the good and bad in this, because it's pretty straightforward. It's the same trade. When I bought Bitcoin in 2013, I was super early, and I had a long-term thesis, and I knew it was going to be volatile and it could go to zero. So the idea was, I bought it. It went up from 200 to 1,000 in 6 weeks. I'm like, oh my God, I've never had something do this before. Then it fell 87%. And I kind of like, fine, you know, I knew it could go to zero, but I think it's got a much bigger upside. And my thesis was 100,000 up to 1 million. And then it kind of did nothing for a while and then took off. And there were the forking wars happened in Bitcoin back in 2017. And I got confused and worried that, okay, I don't know what this is going to mean. Is this all going to fall apart? And I was now up 10 times my money. So I took profits and I felt like a god. And then it went up another 10 times. And I was like, that's okay. I've made 10 times my money. I can't argue. Then it crashed again. And I eventually knew that crypto, and particularly Bitcoin at the time, and macro would merge in the next recession.